Hey everyone, welcome back to another episode of Accounting Explained by AccountTutor.com. Have you ever wondered what your business really looks like financially? Not just the cash flow or profits, but the full picture. What you own, what you owe, and how much is left for you as the owner. Well, that's exactly what we are diving into today with one of the most essential financial statements, the balance sheet. Think of it like a snapshot that answers the big question, what's my business worth right now? In this episode, we will break down how the balance sheet works and what it reveals about your business's financial health. The structure of the balance sheet is based on the accounting equation, assets equals liabilities plus equity. This equation is at the heart of accounting because it ensures everything your business has is accounted for. Let's break it down to understand how the balance sheet works and what it tells us about a business. Let's start with assets, which represent everything your business owns that has value. Assets are resources your business can use to operate and grow. For example, cash in the bank, equipment you use to provide services, or products you sell to customers. Assets are further categorized based on how quickly they can be turned into cash. Current assets are the ones that can be converted into cash within a year, like cash itself, money customers owe you, called accounts receivable, and inventory, which refers to the products you sell. Imagine you own a bakery. Your current assets might include $5,000 in cash, $3,000 worth of unsold goods like flour, sugar, and pastries, and $1,000 in payments pending from a cafe that bought from you last week. Then we have non-current assets. These are the resources your business uses over a longer period, like property, equipment, or vehicles. For your bakery, non-current assets might include $50,000 worth of baking ovens, display counters, and furniture. Combined, these assets represent everything your business owns. Next, let's talk about liabilities. These are what your business owes to others, and they're split into obligations due in the short term and the long term. Short-term debts, called current liabilities, are amounts you need to pay within the next year. For the bakery, this might include $2,000 you owe your suppliers. For flour and sugar you have already received but have not paid for yet. It might also include $1,000 in taxes due soon. On the other hand, non-current liabilities are long-term obligations. These are debts you will pay off over a longer period, like loans for big investments. If you borrowed $30,000 to buy those high-tech ovens for your bakery, that would fall under non-current liabilities. Liabilities show how much of your assets are funded by borrowing. The final component of the balance sheet is equity, which represents the owner's stake in the business. This includes the money you have invested in the business, as well as any profits the business has earned and kept. Let's go back to our bakery. If you started the business with $20,000 of your own money, and the bakery has made $10,000 in profit that has not been withdrawn, your total equity would be $30,000. Equity reflects the value of the business that belongs to you as the owner after all debts are accounted for. It's essentially the net worth of your business. Now let's bring it all together. Here's what a simplified balance sheet for the bakery might look like. On the asset side, you have $5,000 in cash, $3,000 in inventory, and $50,000 in equipment, giving you total assets of $58,000. On the liabilities side, there's $2,000 owed to suppliers, $1,000 in taxes payable, and $30,000 in long-term loans for total liabilities of $33,000. Finally, under equity, we see $20,000 in owner's investment and $5,000 in retained earnings, totaling $25,000. The equation balances perfectly. Assets equals liabilities plus equity, or $58,000 equals $33,000 plus $25,000, and there you have it. A balance sheet in action. It's more than just a list of numbers. It's a tool to understand your business's financial position. Investors, lenders, and even you as the owner rely on the balance sheet to make informed decisions. Remember, every transaction your business makes impacts one or more parts of the balance sheet, but the equation will always balance. Thanks for watching. If you found this helpful, do not forget to like, subscribe, and visit AccountTutor.com for more accounting insights and training. I will see you in the next episode where we will explore another critical financial statement. Until then, keep learning and keep growing.